Every major collapse announces itself long before the headlines, not with sirens, not with crashes, but with signals most people are trained to ignore. Right now, those signals are everywhere. Valuations sit at historical extremes. Debt levels are no longer theoretical, they're operational. Liquidity behaves strangely. Insiders are not acting like optimists. This is not a normal late-cycle environment. Multiple indicators that preceded every major U.S. downturn are already triggered. Not flashing, not warming up, triggered. The question is no longer if the United States enters the crash sequence. The question is how far along it already is. History shows that by the time the public senses danger, the first stages are long finished. And judging by the data, that is exactly where we are now. Stage 1 is exit. This is where smart capital leaves quietly while confidence is still intact. Historically, this happens 12 to 18 months before the visible break, and the evidence is clear. Corporate insiders have been selling at rates comparable only to pre-crisis periods. CEOs, founders, executives, the people with the best visibility into real earnings and future demand, are reducing exposure, not increasing it. At the same time, the largest pools of capital are holding unprecedented levels of cash, not because they're afraid of markets tomorrow, but because they are preparing for opportunity later. This is not market timing. This is cycle recognition. Retail investors are still buying narratives. Executives are selling reality. That tells you stage 1 is not approaching. It has already happened. Stage 2 is insurance. This is where sophisticated investors stop debating direction and start paying for protection. Historically, this phase is visible through behavior, not headlines. Volatility instruments show sustained demand. Downside hedging remains elevated even during rallies. Credit protection is no longer cheap, because someone is willing to pay for it. This is exactly what happened before 2008. Insurance always looks unnecessary right before it becomes priceless. What matters isn't the noise, it's the persistence. Hedging activity hasn't disappeared with optimism. It remains steady. That only happens when capital expects instability. Not tomorrow, but soon enough to matter. Stage 2 doesn't mean panic, it means preparation is already funded. Stage 3 is precision. This is where capital stops hedging broadly and starts targeting weak links. Every crisis breaks somewhere specific first. Right now, those stress points are no longer theoretical. Illiquid assets priced as liquid. Debt structures built for zero-rate worlds. Institutions dependent on refinancing, not cash flow. You can see it in balance sheets. You can see it in funding costs. You can see it in quiet restructurings that don't make headlines. This stage is dangerous because it still feels contained. But history shows containment never lasts. When pressure concentrates, failure accelerates. And once stage 3 is visible, stage 4 becomes inevitable. Late in the year, markets behave differently. Liquidity thins. Risk tolerance drops. Balance sheets matter more than narratives. This is when fragility reveals itself. Historically, many major dislocations didn't start with crashes. They started with inability to stabilize. Small shocks move prices more than expected. Support levels don't hold. Confidence erodes quietly. The end of the year isn't when cycles end. It's when they lose resilience. And resilience is already weakening. Stage 4 is where wealth changes hands. Not because of genius, because of positioning. This stage always feels impossible. Prices collapse faster than logic. Liquidity disappears. Fear overwhelms fundamentals. The people who win here are not braver. They are prepared. They exited early. They hedged patiently. They preserved capital. Stage 4 doesn't reward prediction. It rewards survival. Most investors fail not because they're wrong, but because they're late. They stay fully invested too long. They underestimate volatility. They assume exits will always be available. History says otherwise. Crashes don't ask permission. They don't ring bells. They don't offer clean exits. By the time the narrative shifts, flexibility is gone. Understanding the cycle doesn't guarantee profit, but ignoring it guarantees vulnerability. So where are we now? Stage 1 is done. Stage 2 is active. Stage 3 is visible. That leaves one phase ahead. History suggests the transition from late stage 3 to stage 4 is never smooth. It's marked by instability, failed recoveries, and sudden repricing. What happens next doesn't need a date, but the window is narrowing. And as we move deeper into the next cycle, the question becomes unavoidable. What indicators will confirm that stage 4 has arrived? And will you recognize them when they do? Because if history is any guide, the period ahead, especially as we approach the next few years, will test systems, balance sheets, and confidence in ways the public isn't prepared for yet. The cycle doesn't announce itself, it reveals itself. And right now, it's speaking clearly.